Welcome, ladies and gentlemen. I see you guys getting a bit crazy in that chat. I've been here, man. I've been here. I've just been watching, making sure everything is set for the FOMC. So, market is in wait and see mode. What are we listening for? Tonight, we're going to be listening to see if Powell is going to come across as hawkish with interest rates going into the new year, 2025. Are they really going to give the market the 1 full point cut that they're expecting? Now, word on the street is that a couple of speakers have been saying the Fed needs to pause. Pausing on the interest rates right now. That's naturally going to just be beneficial for the US dollar itself. Look at dollar yen. That seems to be doing all right as well. Man, if he does say the possibility of pausing the interest rates is something that they're going to reveal, then, oh man, we might get a little bit of a reaction in the marketplace. So what we're going to do, guys, in the next 20 minutes, we'll be getting the FOMC projections. We'll also get the actual federal funds rate cut itself. We'll be moving down to 4.5%. And then once that is done, that will give us about 30 minutes just to break everything down in terms of price action. We'll have a look at some altcoins that might be making a move, some stocks that are making some movements in preparation for when Powell decides to step up to the mic and start giving us the truth about what the Fed has in store for the US economy. So let's get with the program. Welcome to tonight's live. Mad love and respect, everyone. I hope you're all doing well. Let's get with the program because we've got 20 minutes, or actually 15 minutes now before the party starts. I'm excited for this one for some reason. Well, anyway, let's get to it. Here we go. So, stocks, bonds, wait and see. Having a look at what's going on across the board, we do actually have a couple of things that are happening. The US bond market itself is currently staying sideways. And remember what we said earlier on this morning about JP Morgan's treasury investors as such have been favoring longs on the bond market, okay? Hedge fund managers have actually closed, or should I say covered all their shorts. There could be an anticipation for the bonds to actually climb up. If the bonds climb up, that means the yields go down. Yields have been coming back a little bit, which is naturally going to be helpful for the stock market. Going over to NASDAQ, you can see it's just trading at these highs right now, very close to the all-time highs. So it's one of those where it's going to either break to the upside or it's just going to take a complete drop to the downside and start recovering these vector candles that we've got going off inside of this range right here. Courtesy of the volatility index, this is good news. As long as this thing is coming down, it would then suggest that investors are actually favoring risk. So it looks like there could be a few calls coming into play with price getting ready to mark higher. But we've got to be paying attention to this volatility index in case it does actually start to mark up, which could then suggest that assets will depreciate as the session goes on, okay? Now, remember, guys, we've got the actual press conference itself. So you can see here it says that we have got the funds rate coming out in the next 20 minutes or so, 15 minutes. We've got the projections and the statement. Now, regardless of whatever is discussed in the statement itself, investors are going to be looking for keywords, all right? They're going to be looking to see if the statement is going to be hawkish. Are we going to get those rate cuts in the future or not? I think what's going to happen is they're going to stick to the story that we already know. They're going to cut the data, they're going to cut the interest rates, and it's going to be on a data-by-data basis. They had the inflation rate coming in higher. What more data do you need? The data that they're actually looking for is the labor market. So if the labor market does start to show weakness, then that is going to grant the Fed to cut interest rates aggressively. If they don't cut the interest, or should I say, if the jobs market doesn't show a contraction and there are more people in work and less people claiming benefit, the Fed in principle doesn't really have anything to worry about. Inflation is a bit of a sticky thing, but if the labor market is okay, economically speaking, they have nothing to worry about. But remember what we said, man, those 12 economic indicators are suggesting that the stock market going up, but the economy is not backing that reason for going up. It kind of puts us in a bit of a sticky situation about what we could actually go into in the new year. But as it stands, stock market is loving life. So we'll go with that instead. And that's exactly what it is. Going back into it all, ladies and gentlemen, just having a look at where we are in terms of price action across the board. We have Bitcoin trading so close towards this 105 region. It's tapped the 50 EMA. And it's done that since what? Okay, the 10th. It's marked up away from that. We've had a bout of volatility. Now it's starting to pull back. And what I'm paying attention to is the fact that The pullback on Bitcoin right here is not as aggressive, okay? You see lots of wicks coming into play. You've got the data that's coming out in terms of bids and offers. We don't really have that many bids coming into play. I think they've done all the bidding this morning. And then we've got some offers coming up to the top side right here at 105,200. Got lots of imbalances coming into play, which will take us towards the all-time high anyways. Having a look at what's going on in the crypto space overall, $3.69 trillion of market cap. Fear and greed is going up. Dominance on the side of Bitcoin. Altcoins are taking a smack across the board. And having a look at altcoins itself, I mean, if we go over to Solana just for a second, you can see Solana, she hasn't really been doing too much ever since that pump fund story has been eliminated. You're not really seeing people playing Solana as much. And she is consolidating pretty well inside of this zone. So I'm guessing that if we do start seeing Bitcoin making a bit of a move to the upside, we'll probably see Solana trying to make a move as well. BNB has been doing really well to hold at these gains as well. Now, in terms of DeFi and what have you, total value locked, and the last time I looked was around 140 billion-ish. So it seems like people are putting money together. They're staking. They're taking advantage of the APYs and what have you. And I think we're in that staking season right now. All right. So remember, when you're staking, you're effectively behaving like a bank. You are accumulating. And you've got to also be mindful that when you do stake, make sure that you are taking something off the table. In other words, get rid of your liquidity, take advantage of the coin that you've generated a return from, hold it if you think it's worth it. And if it's not, take the liquidity out, get ready to go into the next farm and put it over there. So that's something that I would be really cautious with right now, especially with Binance coin holding out. Binance Smart Chain, it's always got those decent APYs in my opinion. Okay, going over to Ethereum, same story with Ethereum. She keeps on making highs, and Ethereum has yet to clear that 4,000 with conviction, but it's in a trend. It's progressively marking higher. So that's what we've got to really be paying attention to with Ethereum. She's also holding out inside of this range right here. So that's something we've got to take into consideration. Now, with that being said, guys, Fed's expected to cut the rates by 25 basis points in the meeting. Okay, so just to bring you up to speed with it all, it says here that the capital update predicted that the Fed would cut rates by 25 basis points, which is what we're getting. Company further speculated that rate cuts might be the last the US receives in a while, which makes sense because there is speculation that the Fed speakers want the Fed to hold. Pausing on the interest rates, it's not looking promising there. Let me just quickly have a look at what's going on in the ETFs beforehand. We should be seeing some ETFs showing a little bit of promise. Again, look what's going on. The SPY ETF is marking up. Vanguard 500, iShares Bitcoin Trust. That's the one that's got the most amount of liquidity going into it in the last 30 days. Looking at the bond as well, the fixed income bond of Vanguard, that's also coming up in the table as well. And the Russell, small caps as well. And then you've got the, it's when I see, look, bond is coming up again. When I start seeing the bonds ETFs coming into play, that gets me a little bit concerned because it kind of means that investors might be going into bonds and taking risk off the table to then go into low risk, which is the bonds market. Okay, so going back into it all, guys, we're just quickly having a look at the time. We've got 10 more minutes until it happens. Just want to quickly have a look at what gold is doing. Gold is taking a bit of a nosedive back down. And theoretically, when they cut the rates for the dollar, gold in principle should start to mark higher. Okay. And we're not really seeing that behavior happening right now with gold. And gold has been very difficult to trade in the sense where you're just in consolidation, pump, and then it just brings it back down again. But I do have an expectation that gold is going to clear its all-time high again in the future. Remember what happened to that Russian general? He was killed. So there could be a little bit of a problem with that. But good news, though. I've got some good news for you. Apparently, Bank of Japan are actually going to hold on the interest rates. They're starting to release articles saying that Bank of Japan is expected to hold interest rates. So we don't really have the concern of the carry trade principle being unwinded. So that effectively means that yen is going to go down. Fundamentally, dollar could be going up again. And again, we've got to pay close attention to dollar yen itself because it is starting to climb upwards. And we've got this structure right here where you've got a little W formation right there, rise, retrace, very small retrace, and then continuation to the upside. And I think tonight will give us the understanding that if that's going to be the case, then investors will be plowing into bonds. The dollar itself will look to go higher. Stock market will be then going lower. Will that be the case for cryptocurrency? Who knows? because Bitcoin has been bucking the dollar's trend because you've got more purchasing power with your dollars, haven't you? If your dollar itself has been increasing in value and you're at what? 6% appreciation on the dollar and Bitcoin's going up, means that you've got more dollars to buy more Bitcoin for less kind of story. Okay. You don't need to have more dollars to get Bitcoin. You now can have less dollars and get more Bitcoin in principle. So that's really why we got to pay attention to the dollar dominance in itself. Okay, any questions? I've got a poll running up there, and it says here that will Bitcoin clear its all-time high tonight? Okay, well, I can't even spell high. What a guy. Okay, so 75% of you have voted yes, and 25% of you have said no. Let's trade the S&P 500 live during FOMC. Yeah, if we want to waste and burn money, then we will do that. No, I ain't going to do that. Not with FOMC. It's just too much. Not with this meeting, given it's the last meeting of the live of the year itself. Okay. Going over into other things, let's have a look at where we are with the ETF. We're going to be going shortly into the FOMC projections themselves. We're going to find out exactly what the story is, and then I'm going to go over a few things with you all. We're going to talk about a few strategies. We're going to go over a few coins, and then that will just lead us into the actual FOMC press conference. Okay. That fart coin is unbelievable. It's unbelievable. So, ETF, not really seeing anything happening. Coinbase has been playing around a little bit. So they've been buying the Bitcoin, sending it to Grayscale. So Grayscale's been loading up. Wisdom Tree's been active as well. Not really seeing, here we go. So Coinbase Prime Hot Wallet, 23 hours ago. Yeah, we understand that because BlackRock did make that purchase, about $750 million worth of it over 5 days. So BlackRock is doing something, and it's all happening before the FOMC, you know? Which means statistically, guys, like when you're waiting for this event short term, right? When you're putting the logic together, interest rates getting cut in the dollar itself tells you that yield on the dollar is not favorable at that point in time. So certain swap investors, traders are going to exploit the fact that the yields are now lower in the dollar. That's why everyone's going into the bonds right now, because they want to lock in yield. Then they think that it's because they're cutting the interest rates, it means that they're going to get a less of a rate of return holding the US bonds. That's why the bond ETFs are starting to outperform. That's why JP Morgan's got a lot of guys favoring longs in the treasuries in their investors. So it's all starting to make sense and get a little bit clearer at what the expectation is of what price is likely to do going into the actual cut itself. Euro principal should be moving up because the dollar itself is no longer lucrative in yield. But it's at that moment in time, you're going to get a couple of reactions. You'll get the reaction from the rate cut, then the projections, then the statement, and then Powell's going to solidify it all and let us know if really what the plan is. So that's something we've got to really pay close attention to. Okay, then. Bitcoin won't take all-time high today. That's unlikely. We'll close between 105, 106K. Maybe, possibly. Let's quickly just go and have a look at where we are in terms of order flow just for a split second. Here we've got Ethereum in the middle. We've got Bitcoin pulling back a little bit. Just looking at other things as well. Yeah, Bitcoin's pulling back just a little bit in the depth of market as such. We're above the point of control. So as long as we're above that point, then we are okay. Ethereum is trading towards the high value area, high region itself. I've got 5-minute time frame right here, looking like Ethereum wants to try and climb up a little bit more. I've got the 4-hour time frame over here, and it looks like it wants to try and succeed that and get above the daily high of the initial balance. We've got some imbalances all the way up here. That could be a sign that we could be getting Ethereum making a little bit of a move. If you look closely here as well, you can see these imbalances. So logic says that we would naturally anticipate Ethereum to try and make that move to the upside. But I do think, right, that when we go into the FOMC meeting itself, I don't think like even the projection, I think they're going to, I don't know if they're going to move straight away. It might be a little bit delayed. It all depends on how the NASDAQ is going to behave, to be honest with you guys. So I'm going to be paying close attention to that. Let me just sort out Bitcoin over here. Let me just bring that up because we are getting very, very close to that little story. And let's have a look if it does decide to do anything. We'll pull that up right there just to understand where we are in terms of order flow. Okay. Now, whilst we're doing that, I've got a little bit of an announcement to make. Plan is I'm coming to Florida. We're going to be doing a meet and greet. We're going to team up with, hopefully get it all sorted out. Just waiting for some certain dates. We're looking towards the end of February, but we're going to be coming to Florida very, very soon. maybe with Frankie Candles, Jason Casper. We're going to try and bring them all together, something like that. But that's what's in the pipeline going into the new year, ladies and gentlemen. Okay, so that's going to be pretty interesting. Then you'll get to see how tall I am. So you'll get to see how tall Mike is. And then you know how tall I am. All right, ladies and gentlemen, we got 3 minutes, man. We got 3 minutes into this. I'm just waiting for this story to come into play. Bitcoin's starting to make a little bit of a move up right now. Ethereum's coming up. God forbid. Like, I hope that they have I don't want to say that. I anticipate that if they have moved prices down over last night and this morning to only bring them back up again to claim the all-time high, that would be wonderful for us all. But if they bring it down, oh my God. The thing is, the Fed, there's nothing that the market isn't aware of. What more could the Fed do? We know they're going to cut the rates. We know they're a little bit, a little bit concerned about inflation. The only thing that could rock the markets right now is if they turn around and say, no rate cut. Oh my God. Unbelievable. Here we go. So we're seeing movement right now. What I'm actually looking for, okay? What I am looking for is if we do get a big step down. This is the ladder right now, okay? And I've got Bitcoin in the middle here, okay? I'm effectively looking to see if there's going to be a step down. And what do I mean by step? This is a ladder, okay? If I see a big order push the market down, that for me will be a sell. Like there's something happening. They're getting ready to mark lower, okay? But I'm not seeing that. And the data's going to come out in a second. Are you bringing Sam now? Am I bringing Sam? The second the information comes out, there will be some fluctuations. So I've got to be very careful with all of this. Be absolutely careful with it all. It's going to be very interesting to see if they actually do something stupid. But I'm anticipating that crypto doesn't do anything stupid because sometimes, even if the market's going crazy, Bitcoin doesn't move straight away. And I've always said this, Bitcoin is last to move, all right? So this is where it gets interesting. Here we go. We should be getting the data coming out. And then when the data's out after 2-3 minutes of watching price action, we'll review what the data has said. If some of you have here we go. Here we go. This is where it gets very, very interesting. Not really seeing anything. Could be good news. Data's not just out yet. Here we go. Why? What's it doing? What's it doing? That's all right. See, look at Bitcoin. It's not really doing much. Speeding up a little bit. They're waiting for the data right now. Looks like it could gain traction. Ethereum's moving. Here we go. Ethereum's moving up. Wait. NASDAQ coming down. It's already down. Not really giving me anything. Bitcoin, not really doing much. They've done really well to hold this range. They've done very well. Look, 69 on the offer side, 105 on the bid. Yeah, it doesn't look like it's doing much. Here we go. Let's see. What have they said? Not really seeing anything. Here we go. Federal Reserve statement. No one's posted anything. Wait for my guy. He always comes up and posts something. Yeah, inflation in the UK has gone. Okay, so now we're starting to see some movement. Here we go. Still trading at the highs. Still good. This is still a good spot. This is still a good spot. I'm not seeing anything. Has anyone said anything? Yeah, it looks like it's not looking very favorable. Doesn't look like it's very favorable, but it could be a stop run. That's the thing. It could be a stop run, so they could snap it back up again. This is usually what happens. If they've been using today to mark it lower to prepare it to go back up, then we should be seeing price go back up now, technically, because they've just marked it down and now they're marking back up. Here we go. Any information on the FOMC press conference itself? Here we go. Issue statement. Usually we've got a guy coming out saying, here we go. Recent indicators suggest that the economic activity has continued to expand at a solid pace. Okay, then. So it's expanding at a solid pace, but unemployment rate has moved up but remains low. Again, inflation itself is the problem. Inflation's made progress towards the committee's 2% objective, but remains somewhat... Oh, it's the same boring information yet again. I think we're going to have a boring FOMC, guys. I really do think we're going to have a boring FOMC. They're not even saying anything. 25 basis point cut. Yep, that's fine. What we need to see right now is the dollar. What's going on? Euro, shoe bag to the downside. As always, we expect that. Dollar is shooting up. I want to see the bonds. Bonds are down. Oh, my days. Bonds are down, but the stock market's not doing anything. That's interesting. Stock market is not doing much. Oil, marking up. Volatility index, coming up a little bit. Ethereum making a move back up. Let's have a look at Tesla, see how she's reacting to it. Doing fine. Nvidia, gapped up, still holding on to its gains. That's fine. The 10-year futures coming down. The yields. The yields are going up, man. The yields are marking up. That might be a problem. I'm anticipating that it's not going to be. The yields are going up, guys. Yields are going up. Right, let me just quickly go into the news again. Anything that I said? Anyone said anything regarding that? Here we go. FOMC median forecast shows 50 basis rate cuts in 2025. That's good news. That is actually good news. It's better than what the market had actually anticipated because they were going on the idea. They wanted 1 point, but they didn't think they were going to get that. But we're getting 50 basis points, which is good. Here we go. Dot spike. So 2025, 3.85% up, 50 basis points from the prior 3.375. Longer run, okay. Longer run, 3 points. That's going to... How are you going to get... Oh, man, it doesn't make sense. How are they going to sustain the debt? By dropping the interest rate? That debt's just going to keep on going. Oh, never mind. Never mind. Yields are going up too much. Bitcoin's pulling back a little bit. Not really seeing that much activity. Ethereum's not really doing much. Looking at across the board here. Just trying to see what I can get from this. But Ethereum out of the two is doing fine. Euro's just taking a bleed and the yen's going down. That's fine. Yeah, that's fine. Let's have a look at the IBIT. That's gap down. Not really concerned. I'm looking at the order flow here. Bitcoin's doing fine. You know what? I'm really impressed with how it's delivered this, behaved right now. And this is what I'm saying, right, about Bitcoin. You've just had, in principle, a macro event that is massive. And I've said this before. I need Bitcoin to tether away from the stock market. This information right now should be sending Bitcoin down by the principle of the yields shooting up, okay? But the bonds market is not going up. It's going down. So what are they doing? They're going into cash, okay? But what's happening now is maybe Bitcoin could be bucking that idea and saying, you know what? I want to go into Bitcoin instead. And that's what we really want to be seeing. Otherwise, Bitcoin's probably going to be just drop. And it's just taking its time to do so, okay? Yeah, it's starting to pull back right now. Ethereum's doing okay. But I need Bitcoin. I need this candle here to be trading positive for me to say, yeah, okay, it looks like it's good news kind of thing. Okay, but it might not be the case, guys. It might not be the case. Bitcoin is starting to sharply move down. Got some orders down here. It's not really doing anything. Ethereum's probably going to follow suit, but they're consolidating sideways. Open interest is coming up. So you got a lot of people closing off longs right now as price is going down. We'd want to see them try and make a little bit of a snap reverse. You've got some orders up there. It could shoot back up. 25 million at 104,900. I mean, it's not looking good, guys. It's not looking good. They're not really giving it to us. Ethereum back into that point of control, man. It's not good, man. Come on, Bitcoin. Where you at? Looks like the market ain't happy today, guys. Looks like it's not really happy. V-shape soon. Maybe there could be a V-shape reversal coming into play. And we ain't even got into the actual press conference itself, which will be starting in the next 25 minutes. So this is going to be very important to see. I'm just looking at other order flow charts as well. It's not looking good, man. Bitcoin really, I'm going to go on smaller time frames. Just understand what we got. It's not that bad. Give me a red vector. Red vectors. Come on. No? Yes. Okay. That's a good sign. That's a good sign. That's a very good sign. Could they be marking up below the key 104,000 zone, load up some longs, and then prepare to mark price up again? It's all going to be based on that move from Powell. It really is. Nah, man. NASDAQ is taking a bleed. NASDAQ could be getting ready to reverse. It could be getting ready to reverse. But the market, oil's not doing much. Dollar dominance. Look at that for dollar dominance. That is absolutely madness right now. It's not good. If the bonds market are not going up, that's a problem. That's not good. Yeah, it looks like everything's just going to take a bleed. It really is. It looks like everything is going to take a bleed. I actually think it's going to take a bleed. It's not going to give us that expectation of a good day. Look at that. That is horrible. It's a violet vector candle. That's fine. They really need to try and snap reverse. Let me see what else they're saying over here. Cuts rates, yep. Standard 4.25. Cut interest rates on reserve balances by 25. Fed says Cleveland's hammock dissented in favor of no rate cut. Okay, then. Here we go. So I added and removed. This is what they're going to say about this. Let's see if that little drop down to the VWAP was worth our time in principle. Here we go. So they added, in support of goals, the committee decided to lower the target rate for the federal funds rate by a 1/4 percentage point. 4 1/4, 2 1/4, 1 3/4, in considering the extent and timing of, why are you getting rid of those words? Voting against the action was Beth Hammock, who preferred to maintain the target range for the federal funds rate at 4.5 and 4 3/4%. I actually think they want to try and pause the interest rates. I really do think they want to do that. Let's go back into price action, Bitcoin. Going back down again. I knew this was going to happen, man. I've just thought to myself, look, cutting the rates go down. But the thing that's got me concerned is the fact that the bonds have been going lower. So everyone's been stitched. Dollar dominance has just said, good night. Euro said, okay, let's go to the down, like parity, ladies and gentlemen. That is disgusting. Did not expect that. I did not expect that for Euro. I did not expect them to drop that much aggressively. Dollar yen going up towards it now. Getting ready to clear it. That is crazy. That is absolutely madness right now. We ain't got no FOMC. Look, they've closed the gap on the NASDAQ, and NASDAQ is just bleeding. Let me just quickly have a look at Bitcoin again. Bitcoin going lower. Maybe, ladies and gentlemen, maybe. If Bitcoin loses this range right here, we might have ourselves a little bit of a problem. We're going to anticipate that they can try and hold this, but doesn't look like it's going to be the case. Altcoins are going to dump big too, most probably. We got a cut, but the dollar rises. It doesn't make sense, doesn't it? It really doesn't make sense. How are you getting an interest rate cut and the yields fly up? This is how you know that the actual statement itself is telling investors that there's probably going to be higher rates in the future, either longer in terms of the pause with the potential for them to increase. This does not make sense. It doesn't make sense. How can you cut the rates yet offer a higher rate of return on the yield for the dollar? It doesn't make sense. The bonds market itself is just taking a bleed. That doesn't make sense. Everyone's positioned to go into the bonds to seek a lower risk to lock in the yield. It doesn't make sense. The Japanese yield itself, that is down, okay? Which means that the 10-year on the Japanese bonds is starting to mark up 0.4%, which could tell me that they might be seeking safety in the yen, but they're not, because the yen's just completely gone to the downside. It's dollars day, ladies and gentlemen. And this fundamentally is always going to be a problem for Bitcoin when investors do this sort of story right now. Be interesting to see how MicroStrategy is performing right now. Let's have a look. It's not doing too bad, to be fair. But it's down 379. Had a nice little open. Not so much a great open as such. Yeah, it gapped down at the open. No, it didn't. Yeah, it did take a little bit of a nosedive, but it's come back down again. I'm anticipating they could mark it up, but I don't think so. It's a red vector candle, man. And that's the thing. Logic says that this is where price could reverse from. But the fact that you've got the dollar dominance showing so much strength right now, it doesn't make sense. Okay, it doesn't make sense. It's dumb that Japan is not increasing their rate, only hurting themselves. When did trading ever make sense? It never does make sense, guys. It really doesn't. Well, when you look at the bigger picture for Bitcoin right now, okay? So look, Ethereum's now trying to come up. Bitcoin's trying to come up. That could be the stop run. It could be the stop run, guys, to bring it up. But they would really need to recover this red vector candle completely. This one right here. They have to recover that for me to say, yep, we're going to try and keep on climbing up. But the dollar's strength, the euro, futures down. All dollar pairs seem to be doing okay. dollar Swiss, dollar CAD, Aussie dollar, sorry, dollar yen, and that's a problem. Aussie dollar down. It's dollar's day. It really is. Bitcoin. Come on. Come on. Surely they can do it. Surely they've manipulated price. Seen anyone try and sell anything? Have a look. Okay. Nothing. No one's selling anything just yet. What time are we on? So we've got 12 minutes past right now. Okay, then. In terms of the system itself and the hybrid system, ladies and gentlemen, this move to the downside is usually consistent with stop runs. Okay, they make the mark to the downside to then make the reversal back up. It's a V-shaped play. Now, the V-shape is something I do talk about. This Excel sheet is a list of all the checklists that I've done for the Platinum members. And we've got a discount for Christmas. 20% off your first month if you join the Platinum membership. That's this one right here. You get 20% off, and the discount code is Christmas. And that's in the description of this live stream. And we've also got BTCC as well. They're doing a competition and a trading event right here. So trade deposit win and trading volume rewards. You get all this fun and games when you play on BTCC, which you can trade NASDAQ, S&P, Bitcoin, all at the same time. So check that out. When you join, you do get, you don't actually get the iPods, but you get the value of it in trading volume as a return. Okay, so go check that out, ladies and gentlemen. And of course, the Platinum membership, where you get access to this. And what I'm talking about here is the V-shaped reversal checklist. Okay, so the checklist itself talks about how to exploit this sort of scenario right here with Bitcoin, because it's effectively doing it right now as we speak. Ideally, I want to see the green vector candle coming into play from this point, and I need this candle to keep on going up. But the best way for you to exploit it is on the basis of price going down. And once it stabilizes, because you'll see that stabilization on the smaller time frames, it's when you see this little pump here. You see that little push? And if it's a green vector, if it's a green vector candle and they come and recover it, usually it would say that they're getting ready to try and make a reversal back up. So it's like a stop start, all right? They can make the reversal, but they can also roll back down, which is why it's important that when you trade the V-shaped reversal point, that you're taking profits along the way. You have to be taking profits with V-shaped reversals because they happen so quick, all right? So Ethereum's starting to pull that move right now, just ever so slightly. We've got it right here. It's come back down to the VWAP. The idea is that we're going to look to try and see if she can continue back up, but you've got an imbalance right there. So that might be a bit of a problem, guys. So just be very careful if you are exploiting that sort of behavior right now on Bitcoin. You ideally want to be seeing the block principle right here. So it's starting to make that reversal up. Ideally, I want to see it try and recover the whole range. If it recovers the whole range in time for FOMC press conference, happy days. Then we'll wait for the next bout of volatility. Quickly going over to the NASDAQ to see if she's doing the same thing. NASDAQ is notorious for it. Completely notorious. Okay, so NASDAQ has been marking lower, but she hasn't actually made the reversal just yet. But you've got to remember, NASDAQ has been going up non-stop. The sell button was clearly not working before. Now it looks like it is. So just be very careful with trying to catch reversals on the NASDAQ. The best way for you to catch reversals on NASDAQ is to wait on the 1 minute time frame and the 30-second time frame. Wait for price to consolidate and create a W structure. NASDAQ loves the W formations, all right? And I'm talking something like this, where it comes down and it starts to consolidate, looks like a nice W formation, and then price will then try and hit back into the imbalance to then shift back up to the upside again. So that's the logic that you're looking for when you're trading NASDAQ, all right? Ethereum's come back down again. Like I said, got to be careful with that. Quickly go back into Bitcoin again. See, it's come back down again. And this is the problem, you know? Come back into that vector candle. Can it sustain it? If not, it's down. They're going to rip lower. So this is the one time they can recover this vector point to then try and make a recovery back up. It is imbalances on Ethereum as such. Any questions, guys, whilst we're getting into it? Tina, what's going on with Japan? I'm telling you right now, Japan has got a problem on their hands, okay? They're either dropping Japan, they're either marking everything lower in preparation for Japan, because dollar yen itself is doing something weird. It's already at 154, hit 154.600. That's no good for Japan. It really isn't. But they could bring it back down in tonight's session, okay? Asian session. So it's going to be big. It's going to be big news tonight, guys, for Asia. Here we go. Let's quickly have a look at see if there's anything else being discussed. Look, dollar yen and being dollar itself being discussed. So they've announced the 1/4 point rate cut on Wednesday. Let's have a look here. Have a look at what they're saying over here in terms of news. What the news anchors are saying. Fed cuts rates for the third time. Listen, we've had Fed pivots, right? We've had a Fed pivot 3 times, okay? And the market's just continued up. So the idea of a Fed pivot has gone out the window, even though historically, whenever the Fed pivots, the market corrects. No, it doesn't. And that's what I mean why things aren't making sense right now, okay? So it says here, the central bank's rate cut 2024 move reduces the Fed's target rate between 4.25 and 4.5%. In the statement announcing the cut, the Fed now projects just 2 interest rate cuts for 2025. 2 interest rate cuts. The Fed moves are designed to prevent the economy from overheating when growth is strong or falling into recession when it's slow. And these are very bizarre extremes that the Fed has to deal with right now. Here we go. So little structure happening right there. Where are we at with time? V-shaped bottom on the 20th. Total market cap shouldn't be able to shed. Yeah, when the candle's going down. Yeah, when the candle's going down, it means that people are buying. Well, people are buying. Look, there's proof of that right now. Look, someone's prepared to buy Bitcoin right here. Here we go. So someone's about to buy a little bit of Bitcoin, 1.4 million at 103,328. Okay, someone transacted a little bit up here for 3 million, okay, missed the trade. So they're going to be anticipating to get filled at that point at 103,500. What's fueling this move down is just investors getting rid of risk, and they can only really get rid of risk if someone is there to pick up the order, okay? So they match their order into the market, and bang, what they then do is effectively match it to that person that wants to buy it. So 103,400 is effectively $6.3 million worth of Bitcoin going to get purchased, all right? And it looks like what's happening is, see all these liquidations here, they're going to get smacked. It's going to be sad. It really is. Bitcoin all-time high is going to get put in the bin. 2.7 million at 101,500. It just, I mean, the offers up here were there. 25 million at 104,900. Total liquidations, 4,824 traders were liquidated. And that was in the last hour. Bitcoin's rolling. Here we go. Starting to roll. Psychological range. Starting to pick up steam. Here we go. We're going into value area low. It's probably going to lose its ground right now. And this is before the press conference. It could end. This can only lead to one of 2 things. Bitcoin's just going to wet the bed, continuously go down, or Bitcoin is going to aggressively rise from these points. But looking at the way the way money is behaving doesn't make sense. Dollar is up. Ultra bonds down. 10-year notes down. 10-year bonds market down. 2-year yield 1.6% up on the 2-year. Oh my days. 10-year. We're close. We're getting close to that 4.5, 5. Oh my God. It's just not making sense. Bizarre asset. Hasn't bloody moved. Never mind. Never mind. We'll talk about other things. All right. 1 hour time frame Bitcoin seems to be sweeping this area. It's a very strong area right now if they can hold it. But if they can't, we've got 39 minutes to establish that. Okay. Big money is buying while it dumps. Retail panic sells. Big money sells to retail and FOMO pump happens. SPX dump was beautiful. Roll down Bitcoin. Okay, then. Tina, where would you short Fartcoin from? I wouldn't entertain Fartcoin. I don't know. It's only Bitcoin, Ethereum, Solana. Even at times, Solana's a pain in the back. So I look at Solana, she ain't done nothing. You know? They're waiting for the press conference, which is something that we're going to be getting ready for very, very shortly. The bleed has started. Everyone... Gold. This will be interesting. Doesn't make sense. It does not make sense. Logic says that gold, yeah, I'll show you what I'm talking about. So you know I'm not talking breeze. Gold interest rates. Look at this. Okay. What are we doing? Right. This chart here shows you there's real interest rate has a negative correlation with gold prices. All right. It is the nominal interest rate less inflation. In the chart, the real interest rate is calculated by the 10-year. Hold on. The 10-year US Treasury bond yield minus the forward 5-year expectation inflation rate in the US. So when both interest rates and prices are rising, when inflation outpaces the interest rate, the real interest rate declines and gold prices rise, okay? So maybe because inflation is starting to come up, maybe investors are like, okay, interest rates are going to stay higher for longer. Gold goes down, okay? So that's probably what's going on right now with gold. The anticipation that maybe, I'm going to ask you all this question. Depending on how old some of you are, if you were old enough in the 70s when the stagflation hit, when the Fed had interest rates at 5%, then increased it out of the blue, you know, they're saying that that's something we could be going into right now. Could be. Could be. Come on, Bitcoin, what are you doing? Hey, it's coming up, man. Seems to be holding out. Ethereum's doing okay. It's come down to swipe back up again. It's very treacherous. This is tricky ranges. W formation on NASDAQ. Let's have a look. Is NASDAQ doing that flavor? 1 minute time frame. There she is. Nice little reversal. This is where it looks to do the kickback to try and see if it can sustain. No vectors, but I know there's an imbalance. Go to the 30-second time frame, quick time. My scalpers, let's have a quick look. Little W formation, sweep the lows. It is lower than the previous one, but they're not done yet. Blue vector candle down there is a problem for me. I don't like that. And NASDAQ can come all the way down to eat that liquidity, and they'll consolidate before the actual news event itself. So, you know, why lock in on a bond now, given the uncertainty in rate for 2025? What am I missing? Well, you're not missing anything, okay? But the market's expectation is that if the Fed is only giving us 2 rate cuts next year, that means interest rates are going to be held for longer. What they're not telling us is when those rate cuts are going to come. What meeting are we going to get that? Is it going to be in the first quarter? Is it going to be in the second quarter, third, fourth? Are they going to do a cut in interest in the first start of the year, in the next meeting, and then wait until the end of the year for the next one? That's dead. That's why the yields are going up, which means it's effectively forcing the Fed to offer a greater rate of return because no one's going into the bonds right now. They're not picking up the bonds. But I promise you, 10-year yield shoots to 5%. You're going to get a nice fire sale on those bonds and everyone will jump in. It's like the market's forcing the yields to go to 5%. They want 5%. And this behavior right here that you're seeing across the board, well, that is usually going to be the reason for the yields moving up. Okay? Tino, why is the Treasury bond down but the S&P up? Can you explain? Well, the S&P itself, okay, is technically not up, okay? It's right now down and they're filling the gap right here, okay? What you got to focus on is if the bonds are down, the yields are up, investors are going to cash. They're getting rid of risk. And this is what you want to look for. You want to look for when the bonds market is trading positive and the stock market trading positive. That means high risk and low risk are being welcomed, okay? So investors are like, yep, let's take everything on, right? But right now we've got bonds are down, yields are up. That hurts the stock market. That hurts tech stocks. Go and have a look at NVIDIA and you'll see NVIDIA right now is doing relatively well because of the gap up, but it's pulling back ever so slightly. Tech stocks are going to be experiencing the pain of higher yields. That's usually what happens, okay? Now, if the stock market is down and the bonds are down, but the dollar currency that is used to purchase this is up, it means that they are transacting in dollars and they are retaining those dollars and holding onto them. Because at 6%, they're doing all right. Where is it? Where's my dollar? I've lost it. I can't see dollar. There she is. There's dollar right there. 7%, man. So now you're in a position to buy more bonds with your dollars. You're in a position to buy more Bitcoin with your dollars, right? More euros with your dollars. So the dollar's purchasing power is increasing aggressively. It's going to put pressure on the yen, I'm telling you now, and they could turn around and give us a nice surprise this evening. So that's what I'm looking out for. I seem to be answering the same question. Tino, does the Bank of Japan have to act now to save the yen against this rising dollar? It all depends on how far the dollar yen itself actually moves, okay? If dollar yen keeps on climbing up, then the Japanese need to step in and intervene and do a forex intervention, which I believe the cost of doing that will be done by increasing the interest rate tomorrow. They can turn around and be like, yeah, we're increasing the interest rate, as in tonight. So they may be waiting to see what happens with this. But let's wait and see. Because we got to get this party started, ladies and gentlemen. Whilst I get the live ready for you all, make sure you're liking the stream, ladies and gentlemen. It costs you nothing to do. Thank you very much. Right, let's get with it. Where is Powell? Let's see what Powell has to say today, guys. I'm just going to... Let's see. Here we are. Bear with me a second. Okay. Powell's going to be jumping on very shortly. We're going to have Powell over here. And then we're going to be paying attention to Bitcoin. All right. No snidey comments either. All right. We're just looking for... We're looking to hear what Powell has to say. All right. GoldenEye. Dude, I've been talking about it for the past 10, 15 minutes, bro. Thoughts on Bitcoin dominance? We'll talk about that in a sec. Here we go. Actually, I can do that right now. Bitcoin dominance. It's not really going anywhere. 57. I mean, alts are just getting smacked across the face. BNB's doing great. This thing doesn't stop. HBAR does not stop, man. Great asset. Dogecoin. I think we just need to wait and see how Asia's going to react. You've got the Bank of Japan's press conference tomorrow. That's going to be the decider for me. Tonight, sorry. And that's going to decide if Bitcoin is just going to take a shoe bag to the downside or not. Okay. Here we go. Let's pay attention to see if Bitcoin can actually pull some flavor with this candlestick right here. Oh my days, oh my days, oh my days. It's going to be interesting. Where are we at with the likes? Come on, man. 3,500 of you amazing people. Yet, you're not here liking the stream. Oh, also, got another announcement to make. I've got two families. I got my first family, then we got the Pattern Watchers family. So, I'm going to be doing a live stream Christmas Day for the Platinum members of the channel. All right, that's why we're doing this discount code. So, you're going to come into that live stream on Christmas Day. And we're just going to talk everything about the hybrid. If there's any activity in the markets, we might exploit that as well, but it's very unlikely. But I'm going to be doing a live stream for the guys. I'm trying to work out the times, but it'll probably be around this time, you know, about 2 p.m. Eastern Standard, or we do it at the times that we normally do the live streams at 9 p.m. UK time, which is around 4 p.m., 5 p.m. Eastern Standard. So I'm going to do a live stream for the guys, Platinum members, Christmas Day, and we're just going to break everything down regarding the hybrid system. Right. When's this thing happening? So, are we doing it? Come on. Wait there. Yes, I'm going to be leaving that. I'm fine with that. I think he's going to be starting right now. Here we go. Don't be talking without me, pal. You son of a gun. Here we go. Good afternoon, pal.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2%. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019. The labor market is not a source of significant inflationary pressures.
Interesting.
The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate.
He can't be bothered.
At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market, while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive.
He's got a
We can
cold.
therefore be more cautious as we consider further adjustments to our policy rate.
Oh, man.
We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year and 3.4% at the end of 2026. These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate.
That was a nice
technical
clean.
note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
No, you do not.
Gina.
Gina, here we go.
Gina Smialik with the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit about why officials think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
Well, so let me start by saying why we cut today, and then move to 2025. So I would say today was a closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals, maximum employment and price stability. We see the risks as two-sided, moving too slowly and needlessly undermine economic activity in the labor market, or move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level, that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%. But 12-month inflation has actually been moving sideways as we are lapping the very low readings of late last year. Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral. At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
CNBC.
Thanks
for
the
Reuters.
opportunity to ask you a question. So this does seem similar to the dynamic in 2016 during the last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place here. But since, so what's really driving the slower rate cut path? First thing is growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I would say it is this. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation in September and October. As I mentioned, November is back on track, but once again, we've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year. So that is certainly a large factor in people's thinking. I can tell you that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still going to be between 2.5 and 3. It's way below where it was, but we really want to see progress on inflation. As I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
Chris.
Thank you, Chris Rugaber at Associated Press. Thanks for taking the question. In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains effective and any other thinking on tariffs generally that you can share?
So I do think that the September 2018 Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today. I'm sure you have them too. They're a good starting point, and I would just say, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And there were two simulations. One was seeing through, one was not. And I'd point you. There's some language in the see-through paragraph that says, that considers situations in which it might be appropriate to see through inflation, and then names some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect, tariffs can affect inflation in the economy, and how to think about that. So we've done a good bit of work, all of us have, each of us has, and it puts us in position when we finally do see what the actual policies are to make a more careful, thoughtful assessment of what might be the appropriate policy response.
Great. And just a quick follow. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite a bit of diversion of trade away from China to other countries since that may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment, but only when we've actually seen what the policies are and how they're implemented. And we're just not at that stage. We're at the stage of doing what other forecasters are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
What a long-winded answer.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%. And as Howard noted earlier, most of the committee sees the risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers.
Got to read what he has to
So
say.
we have
What is
we have
this?
inflation coming down, core inflation coming down to 2.5 next year. That'd be significant progress. You see a slower path. I think that does take on board that we want to see real progress, but we'd be seeing meaningful progress to get inflation down to that level. That wouldn't be all the way to 2%, but that would be better than this year. This year will be 2.8 or 2.9. That would be meaningful. We also have to think about the labor market, and while we have the labor market forecast as being in good shape, we are also mindful that it is still out there very gradually cooling, so far in an orderly, gradual way. But it's also something we need to keep our eye on.
I guess if I could follow up, if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past when the committee thinks maybe it's going to be on hold for a while, and they said, gee, this looks like it could be the last rate cut for some time, would they be mistaken to to infer that?
So that's not any decision that we made at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy does evolve about as anticipated, we're at a point at which it would be appropriate to slow the pace of rate cuts. So extent, that just relates to how much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points. So it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing just suggests, again, that we're at a place where we assuming the economy develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that. We're not trying to make decisions about the longer run. We're trying to make sensible policy as we go. And, I just would emphasize the uncertainty, which is, it's just a function of the fact that we expect significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that happens.
No, we don't know. He's such a boring speaker. I can't believe it. Who we got?
Michael McKee from Bloomberg Radio and Television. Even though you've cut rates by 100 basis points this year, we haven't seen much change in mortgages, auto loan rates, or credit card rates.
Interesting.
You say you're significantly restrictive. Are you running a risk that the markets are fighting against you and the economy could be more at risk of a slowdown than you anticipate?
Great question. Great question.
The rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So we're now well into another year of growth that looks like it might be 2.5%. Second and third quarters were right about at the same level. So the U.S. economy is just performing very, very well, substantially better than our global peer group. And there's no reason to think a downturn is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policy so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts included the phrase, we need to have confidence that inflation is moving down towards our target. Given the fact that you've raised your forecast for next year, do you have confidence or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates. And, look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. Again, you do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents start to equilibrate better with new leases that turn over, not new tenants, but new leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as we expect. Goods inflation, which is another big piece of it, has returned right to the range where it was before the pandemic. Just for some months this year, it kind of moved up in a bumpy way because of used cars and things like that. But we think overall that should generally be in the range it was in. That leaves non-housing services, and market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. I mean, a good example is financial services, which is really done off of asset prices. And that's how that inflation works. So the overall picture, the story of why inflation should be coming down, is still intact. In particular, the labor market. Look at the labor market. It is cooler by so many measures now, modestly cooler than it was in 2019, a year when inflation was well under 2%. So it's not a source of inflationary pressures. Not to say there aren't regional and particular professions where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on, and our policy will do everything it can to assure that that is the case.
Colby.
What do you think?
Thank you. Colby Smith with the Financial Times. So the unemployment rate as of November, while still very low, is within spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on that front, or is it just about there being more upside risk to inflation that now needs to be accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July. And job creation is lower than it has been, but it's been steady. It's not declining. It's steady at a level which, as
this
I
guy's
pointed out a couple of
delirious.
times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might, if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So but you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think you pointed out participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market, and it's because things have just gotten a little bit better. It doesn't, the unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2% inflation. That's what I'm saying. Not that it's not welcome. We don't need it, we don't think. If you had a situation where inflation's moving around by a tenth every few months, that's, we'd have to weigh that against the fact that inflation has, in recent months, been moving sideways in the 12-month window. And so we've got to weigh them both.
Sorry.
And at this point, for a while there, we were only really focused, mainly focused on inflation. We've now gotten to a place where the risks of the two are we think are broadly, roughly in balance. And so that's how we think about it.
Steve. Come on, Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
Simple but effective.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So, and that's just because we've reduced our policy rate by 100 basis points. We're significantly closer to neutral. We still think where we are is meaningfully restrictive. And I think from this point forward, it's appropriate to move cautiously and look for progress on inflation. We've done a lot to support economic activity by cutting 100 basis points, and that's a good thing. I support the decision, and I think it was the right decision to make. I think from now, we are in a place where the risks really are in balance, and we need to see progress on inflation. And that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent with the SEP.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard.
Never seen this guy smile.
High months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months. We shouldn't have, our position shouldn't change based on 2 or 3 months of good or bad data. We have a long string now of inflation coming down gradually over time. As I mentioned, 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still have some work to do, though, is how we're looking at it, and we need policy to remain restrictive to get that work done, we think.
Neil. Thanks, Jerry.
Where are the women in this FOMC, man?
Axios. Financial markets have been very buoyant really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course. That's part of what we do. But, we really look carefully at is the performance of our goal variables and how are we affecting the economy. So what we've seen over the course of, just take the last year, we've seen inflation, over the last couple of years, come down a lot. We've seen the labor market cool off quite a bit. That suggests that our policy is restrictive. We can also look more directly at the parts of the economy that are affected by that are interest sensitive, like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want. A lot of things move financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're hoping to see on the goal variables and the places where we'd expect to see it.
So if I may, speaking of assets that have been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
Fair play, bro.
So, we're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
That was quick.
Andrew.
Is that it? He shut crypto down.
Mr. Chairman, thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years ago.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases, which we think is the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continuous struggle with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The other thing I just wanted to ask about was the You guys have noted that the
Sorry.
unemployment rate is
That's funny.
is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a percent rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is signaling?
Rob, your question's
I don't think so,
boring.
no, I think overall, if you look at it, prime age participation is still very high. What's going on in the labor market is
Go on.
that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers. If you are looking for a job, though, the hiring rate is low, and that's a signal of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual softening in the labor market. Again, not something we need to see to get 2% inflation, and that's part of the reason that explains why we moved ahead today with the action with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high, wages are at a healthy and ever more sustainable level, wage growth, and so the labor market. This is a good labor market, and we want to keep it that way.
Sorry.
Thanks.
I'm so sorry. I just blew your ears off. Oh my days.
Thank you, Amara Mokway from Bloomberg News. I just want to put a finer point on the labor market.
Oh my days, what's going on?
Can you keep the labor market this way, in the strong position that you have described, without further cuts? In other words, do you still view the labor market as needing support to protect against a further cooling?
We can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates, and we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. Job creations are meaningfully positive. Wages are, if anything, still a bit above what would be sustainable if productivity were to revert to its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So, I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. Nonetheless, it's one of our mandate goals, and we pay close attention to it, and it's worth noting that it is still gradually cooling, and in an orderly way. And that's how I would characterize it, and that's why we're paying careful attention.
Elizabeth.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
It breaks down into a long answer if you want, but it just has been a little bit more stubborn. I think if you go back 2 or 3 years, many people were saying that to get this far down, we would have had to have had a deep recession and high unemployment by now. Well, that has not been the case. So,
All right. As it stands right now, cryptocurrency is taking a bit of a tumble to the downside. I had to short this, and I'm getting ready to close this off, but currently in a short on Ethereum right now. And we got ourselves a really decent gain right now. Very interesting. And that entry point was at 3816, and it just keeps on ripping to the downside right now. Nearly a 20 grand trade on FOMC. And I'm very close to actually closing this off. I'm paying close attention to it, because once Bitcoin, I was looking at the ranges, the rejections of the VWAP. It's very interesting to see how they're holding this range. But I'm looking for Ethereum to just maintain this move to the downside. Bitcoin seems to have taken a bit of a reversal, but I'm going to be very cautious with this with Ethereum, because I do think they can go down a little bit more, but I'm waiting to see how this candlestick closes. I'm leaving money on the table right now, so I've got to be very, very careful with this. But I do think that they're going to keep on marking low. I just got to be very careful with the way Ethereum does this. Even ExoCharts is starting to get a little bit funny right now. Wait for it. Wait for it. Nearly 20. I got to be careful here. Could be leaving some on the table. But I believe they're going to try and mark lower. This is short covering. Come on. Got imbalances down at the lows right here. I think I might need to get out. Wait for it to clear that high. Wait for it. Come on. Show me what you got. This is very interesting. Need to see how this candle closes. Then we'll know. That was shit. Yeah, I'll get rid of that. I'll take that. Yeah, that could have been 20 grand just then. But I needed to explore. I needed to wait and see. But it was a fast reversal back up, man. But nonetheless, it was always going to be the case. Always going to be the case. So, look, nothing really has surprised me. Nothing has surprised me with this FOMC. Nothing interesting, to say the least. And you've seen what Bitcoin's done right here. And you can see that it is a sweep of liquidity to the downside. All right. Very, very important. And how quick that move was. How quick that was. But you can see now what's going on. Bitcoin's trying to eat the offers right now. So people are selling, buying, and trying to sell at the same time as it's making a reversal back to the upside. Okay. I knew it, man. I knew it. I knew Ethereum was going to try and come back down to the imbalances. May have acted too soon. I'm probably going to try and re-enter again, but it's a bit of too much of a move down and up. You know, what have I done there? Yeah, nearly 1,000%, $8,000. Could have been nearly 20, but never mind. Not bad for an FOMC with this madness that's been unfolding right now, ladies and gentlemen. All right, and quickly going into some more price action on Bitcoin. Now, for the holders, it's very important, right? This is really important for the holders. Hold on. So holders right now, Bitcoin has now broken the 5 and the 13 EMA. This is important, okay? This candle close has effectively encapsulated or engulfed, as they like to say, has engulfed these 1, 2, 3 days. How this candle closes tonight is going to dictate what Bitcoin might be getting up to from now going in towards Christmas, okay? So if they actually pull price back from here, tonight with the Asian session, you've effectively got the Bank of Japan. And they're going to reveal to us if they're going to continue with their interest rates at the level that they're at, right? Look at what's happened. If the Bank of Japan say we're not going to cut our interest rate, we're not going to increase our interest rates, what does that mean? It means I can now borrow more yen. Fundamentally, we would expect prices to try and reverse back up. S&P, sell button seems to be working, but it's only coming back into these gaps, okay? So just be very careful. You've got another gap down here on the S&P right here. That's crazy, okay? There's lots of gaps all over the place. They need to finalize it, and I'd say that from now going into tomorrow, they could be continuing with this narrative lower, but it all depends on what the Bank of Japan are going to be doing. Euro down 1.23%. Anyone that knows Euro knows that when it's trading at these levels, it is good for a reversal, but not just yet whilst Powell is still speaking. Bitcoin down 4% for the day, guys. Absolutely divine. Absolutely mad. But it is making a bit of a recovery. Be mindful on this wick on the recovery, guys. Any questions? Any questions? Any questions? I know you got some flavor. Remember, ladies and gentlemen, okay, we've got the discount with the Traders Reality website on the Platinum membership. You get 20% off with the discount code. Remember that. Okay, it's in the chat right now on the description. It's called Christmas. Use that in the discount section. Sorry, in the checkout, and you get 20% off your first month. And I'm going to be doing the live stream for the Platinum members Christmas Day. I'll be getting the times over. I'm looking at around about 7 p.m. UK time, which will be about 2 p.m., 3 p.m. Eastern Standard, depending on how the day is. But Christmas Day, 25th of December, I'm going to be doing that live for the Platinum members of the channel. So get involved if you want to join that, where we'll try and take advantage of price action if there is any action on Christmas Day. We all like a bit of action on Christmas Day, don't we? The markets, a sea of red, and Tima is absolutely parabolic. Is it? Interesting. Well, if it's a sea of parabolic, do something about it, bruv. I just lost out nearly 10 grand on a trade that I could have closed off sooner, but I played the game. So at least we walked out with 9, you know? Pay yourself. Now that he shut down the strategic reserve idea, could that be a top signal? Not necessarily, but you know what? Something tells me that if they're going to try and push this idea of a strategic reserve, they're going to go to the Federal Reserve and say, what do you think? I'll be like, shut up, man. Don't try and intervene with us. Remember, we are a private entity. President, you do your thing. But we're a company. We do what we want. That's the problem. So, with that being said, I think I always spend my cash at Christmas, Bitcoin down. Okay, with that being said, I've got some comments here. Hold on. You did have to quote twice, Nine Breaker, man. Sorry, bro. What's a top signal? Okay, a true top signal is a retrace back into it. That's a top signal. Retrace back into it, failure, back down. But being crypto can just slump to the downside, no hesitation. I should have stayed in that trade. Shoulda, woulda, coulda. Shoulda, woulda, coulda. Never mind. Ladies and gentlemen, mad love and respect. I hope you've enjoyed tonight's live stream, but there's a lesson to it as well. You know, Powell is still boring, but hopefully this stream wasn't. Hit the like on the way out, guys, and I'll be checking in with you all tomorrow morning. Take care of yourselves, gang. Mad love and respect.